All right, so we continue to push down to the downside, and the chorus of bears continues to growl louder and louder and louder. So are we now on the precipice of a free fall here? Is that what the technicals are suggesting with our break below 280 or 2800 on the S&P 500 or not? So we're going to break down what this breakdown looked like today and what it means to our expectations going forward. And is this loud chorus correct in what they're saying, or should we expect something different? So again, I walk through the technical routine that we do every day and break that down as to, again, what's driving this sell-off yesterday and today, and how much of a risk-off pattern we're seeing in different asset classes and sectors. And then one way we can be able to trade a sector that has been a strength lately that maybe might not be going forward from here. So let's go ahead and get started. Today is Wednesday, May the 29th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500, as always, with the market forecast indicator here. At one point this morning, both the near-term line and the momentum line were down below the 5th percentile. So we were pretty bearish at the lows of the day, in which case obviously would have meant that we got a cluster on the S&P, and we did not finish the day with a cluster because we came off of the low point, brought the momentum line out. Now, I mentioned last night the intermediate line is now below 20. It doesn't usually stay below 20 for very long. So, I mean, a lot of people kind of look at this as, oh no, this is how every sell-off occurs. But remember, 6 clusters in a row, this was the first time we had that happen since March of 2009, the actual low point. So that's not how all sell-offs or corrections or bear markets, whatever you want to classify this based on how much it pulled back. That's not how they all occur. And so we are in the midst of a 5% pullback. We are sitting, you notice, right around multiple support levels. We talked about this 2800, how we can even go even lower, below towards 2780, and that's where we're at. We finished the day at 2783, right at the low point, this last low point. You remember, breaking below a 1% pullback low, a 1% plus pullback low, was what kind of broke the dam here last October. Obviously, we were just barely starting the dark pink shading, dark red line. We're already in that mode here. So it'll be interesting to see how much this holds. Again, intermediate line doesn't stay below 20 for very long. It turns up pretty quickly, barring 6 consecutive days in a row of clusters. And considering that we almost had the cluster, meaning that we get to this rare situation where the intermediate line falls below 20 on a day with a significant sell-off, which produces the short-term sentiment that gets you the cluster. Usually that's kind of your low point. That marks the low point. So we'll see if we end up trading more within the gap here, or the range of today's low point tomorrow, even, and producing maybe even a longer lower shadow than what we got here today. But again, multiple areas of support around this area. Remember, we're still just within the area of a 23% retracement, much less a 38% retracement. There was a tweet out there from Ryan Dietrich about how many 5% pullbacks. We typically average, like this one, we typically average 5% pullbacks a year. That's the average for the S&P. So this is one so far in 2019. And again, this one is coming off of a 25% rally where we didn't even get a single 2.5% pullback during that whole time. So that kind of gives you an idea of how bullish we've been, for how long we've been bullish, and also should put this in context. We think about how big that is, but then we put the size of this next to the size of this, and we think, well, wait a minute, we're a lot more bearish here than we are bullish here. And the reality is, of course, context always is key. Context is key in a lot of this. So remember, bear markets sneak up on people. They don't necessarily come where everybody's expecting them. So the more chatter there is, expectations of recessions and bear markets, the louder that chatter gets, the more likely we are to find a low point. somewhere in this area and bounce off of that. So that being said, we are in a bearish mode right now, dark pink shading and a red line, right? But we have the intermediate below 20, which is doesn't happen for very long. It doesn't stay down there for very long. The Dow Jones Industrial Average also came really close to a cluster, flirting with it today, flirting with this 25,000 level. The NASDAQ Composite flirting with 7,500. Again, the intermediate line down here below 20, down to a relatively low level than we ever got over here. And then again, it was as low as we got in these areas. And then finally, the Russell 2000, which has been down here as well. It did get a bunch of clusters, and still no clusters yet at all during this pullback of the intermediate line to below the 10th percentile. So kind of, and the Russell has pulled back to the 38% retracement of this rally it had off of the December 24th low to its high. So again, it kind of gives you an idea that we are, you know, as bearish as we are with dark pink shading and red line, we are still just pulling back towards the top of the Fibonacci retracement zone between this 38 and 62% retracement levels. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo here in the bottom right corner of your screen, then hit that red subscribe button that pops out. There's also a red subscribe button below the video that you can see down there. Also, click the thumbs up icon that's down there. That tells us, number one, that you got something out of the video today. It also tells us, two, that you want us to do the video again tomorrow. It's a quick way to give us feedback. You can click on that right now while you're watching, in fact. Finally, comment down there on anything that stood out to you from today's video. Join our daily Market Outlook email list. We have an email list that we send out to subscribers on a timestamp summary of this video with watch lists of stocks that are forming clusters, as I mentioned, on the market forecast, individual stocks. So make sure you subscribe to that to get that list. There's a link popping up there. Really easy way to subscribe. Follow me on Twitter for more content like this in between the videos from day to day. And then join our Market Outlook community that we created on Facebook. Also, if you haven't already, subscribe to our website at marketscholars.com. It's a really easy way to do it. You can do it for free. There's a button right here to the right of the video if you're watching this on our blog. That allows you to participate in our Market Outlook forums with other market scholars. Of course, premium subscribers get access to our classes. You can see the class schedule we have coming up to the right of the video. And of course, today's Market Outlook tweet, Facebook posts, very easy way for you to interact and engage with those. By liking these, by clicking on these images, and you can like this video in our community right here with this button. Again, the more you engage, especially with these social networks, the more you tell them to keep pushing you the stuff that we put out there day by day on those different platforms. All right, back to the charts. Let's take a cool look at the long-term chart of the S&P 500. And of course, it's a pretty bearish candle coming to the 200-day moving average. Not surprising. We've been talking about that as the possibility, as the expectation that once you get into the gap between the 50 and the 200, especially after a golden cross, you tend to test, like you saw before. In fact, you can see over here, we went pretty far below the 200-day moving average on an intra-week basis before rallying really quite a bit that week to close up above even the 50 and close towards those highs. Over here, we actually closed below the 200-day moving average before rallying the next week. So, and you can see other here back in early 2018, we dipped below it. We dipped below it a couple of times later, but then rallied right off immediately off of that. Again, very similar expectations coming off of a golden cross as we had before with this test of the 200-day moving average that we're getting. Remember the Hakunashi candles here. This is a good bearish Hakunashi candle, and we were expecting, one this week. When we did the market outlook last week, we were getting it. Most likely we'll finish with it with 2 more days left in trading this week. Now that we're halfway through this holiday shortened week. And then next week we'll probably start getting candles more like this, where they're kind of upper and lower shadows with flirting with small bodies that transition us into the rally that again is expected off of this into the rest of the year. Remember, we on average get 5% pullbacks a year. This is only one so far this year. So to get another one, even by the end of the year, even if you expect us to be higher towards 3,000 by the end of the year, to get another 5% pullback definitely would not be unnormal at all. abnormal, abnormal at all. So I had to look that up because I was like, I don't think unnormal is actually a word. So let's take a look now at the 3 green arrow charts, and you can see obviously 3 red arrows here. We're below the falling moving average. That's a bearish pattern, of course. If you take a look at the 2 line versions of this chart, you can see how bearish we are. The MACD is starting to get a little bit lower. Now remember, the MACD is actually an absolute value of the difference between the 8 and the 17-day exponential moving averages that we're using here with this time frame, with the 6-week moving average in blue. This PPO is a relative value, so it takes a look at that MACD and compares it to the 17-day, no matter where the value is, from 1800 all the way up to 2900. So it puts it in some relative perspective here. You can kind of get an idea, as bearish as we are, we're not nearly as bearish as we were. The 2 pullbacks, the 2 corrections, I guess you could say, that we got in 2018. More bearish than we ever were in 2017, and similar again in size to the pullbacks we had in 16 on Brexit and then on the election before rallying off of those. And obviously you can see where the big death crosses were on the S&P 500, much lower than where we're at right now. And this is kind of a typical, and again with the stochastics even, you can see the blue line doesn't stay below 20 for very long when you are not in a death cross environment. Even when you are in a death cross environment like you are here and like you are over here, it doesn't stay for very long, similar to the intermediate line on the market forecast. And interestingly enough, again, when it is down below 20, that is when the chatter for recessions and bear markets is the loudest, right? So keep that in mind. Every time it's below 20, as you can see on this chart, that's when the crowd that gets the loudest, the bearish crowd gets the loudest. So it doesn't mean that we can't enter a recession right now. It doesn't mean that we can't be in the early parts of 2007 right now. We'll talk about that here in a little bit. But as we've seen before, there's a lot more precedent that when the crowd gets the most bearish, that tends to eventually set the low point near that area, especially with as much volume support that we've seen. Remember on the Bollinger Bands here for SPY, we bring up SPY, there's a lot of volume support in this area where we're at right now. And we're not even touching the 38% Fibonacci retracement, which is right here. So again, it's not like we're free falling through some low volume areas here. There's a lot of support, a lot of buying interest, a lot of trading at previous levels, previous times at this level that can, again, help set the low point. Let's take a look at the intraday chart. You can see we did gap down. We did form a lower high and a lower low. Obviously, we're trading completely below last week's low point. That's that brown level there. We'll see if we finish the week below that low point. But bearish day, and not as bearish as it could have been, right? Because we actually had a small range after the gap. Now, when you include the gap, if you take a look at the range here, let's go over to this chart and take a look at today's range. Without the gap, we were below average. But of course, we closed yesterday at 280.15. The high today was 279.36. So about a 75 cent, a 3/4 of a point gap. So you add that on there, and now we are right about at the average, which it's not too bearish to be right at the average of the ATR. The volume was a little bit above average at 105 million almost. But put that in context, 105 million is right here. So again, we're kind of in the middle point. 125, 150, that's your areas where you're concerned, right? And 5 to 6 points, that's what would get this line up above 2%. That's when we get, concerns for being more of a correction, and we're still not, that we're not in that mode. And finally, if you look at the VIX, so you remember here, we're lower than we were on May 13th. That was the lowest point that we got on May 13th. We'll look at the VIX, and you see here's May 13th right here. It's actually lower than where we started on May 9th. But there's May 13th. There's the highest close that we had, as you'll see on the daily chart in a second. It's the only time that we've closed above 20 during this pullback. Today we didn't even close above 18. We did get up above 18, but we finished down below it, and we finished still in the lower half of the bearish range. So kind of typical and expected, and kind of shows that the volatility. The volatility is not suggesting that the market is surging, up towards these surge levels, up above 20, up to 115% here. We're not surging to these levels. When you start these, see, this is when we get these big surge and we close at the high. See, we didn't even close at the high today. We opened at the high, close to the high, and came down. Those are the days you worry about, when you close at the highs on volatility, and the volatility ranges all the way up to this 115% level. It's hard. It takes a while for it to the market to find the low point when you get these surges, as we saw here, and even as you go further out in time to other instances where we've surged, right, in early 2018. It took a while for this low point to occur, for us to get below the neutral zone between 90 and 95% and stay down there. So, we're forming an intermediate pullback here, as we've seen lots of times before, without a surge, and we're figuring it out and setting the low point probably somewhere around this area, and eventually bouncing back up. And it will take a while to bounce back up, but again, this low point's taking a while to form because of the rally, the 25% rally that preceded it. Took a long time to form there. That was a 4+ month rally, which in a time frame that typically only takes 1 to 3 months, and usually only one month plus when you're coming off of a golden cross. We usually typically get a pullback towards the 200-day moving average after the golden cross, to test it and bounce, and then we get going for your 1 to 3, 2-3 month intermediate run. So we had a 4-month run, so the pullback is taking a little bit longer to form as well. So to summarize from our outlook here, our routine here, before we look at what's driving the price action in our trade example of the day, but a quick mid-video summary with our technical analysis look is, yes, we are bearish right now. Yes, the chorus of bears is getting louder, but we're also seeing some technical signs that tell us we're probably getting closer to a low point near these support areas that we're hanging around at than we are on the precipice of a free fall, which, as I've shown you before, typically occurs at the end of bear markets, not necessarily at the beginnings of bear markets. So a lot of technical signs suggesting, yeah, we're still in the process of forming a low point. It's longer, it's deeper than what people are comfortable with, because the rally was a lot higher than what people should have been comfortable with. It's taking longer to form than people are comfortable with, because the intermediate rally was a lot longer than what we should have been comfortable with. And so now we just have to let the markets figure themselves out, figure this low point out, and eventually come off of that. And of course, things can change, but from a technical outlook, that's what we're coming up with. So what do you think? Do you agree or disagree with that assessment? There's a link popping up there. Click on that link. It opens up a poll. Then you can hit either agree or disagree with that market outlook. Of course, if you disagree because you see something else that I didn't share so far in this video, or later here afterwards, comment on the section below and share that with other market outlook viewers here. That anything that you're seeing that would suggest either you are a lot more bearish than this, or we're bouncing up. We're going to be a lot more bullish than even I think we're going to be. All right, now let's take a look at what's driving this price action. And it kind of reminds me, as I pull up these charts, that in all of our classes, as we've been rallying up for these 4 months, I kept you move those Fibonacci retracement lines up as we keep forming new highs, and the gap gets bigger towards these 23 and 38%. And during the last month of this rally, I kept the common theme was, if and when we do get this pullback towards this 23% line, and eventually maybe even the 38% line, it's going to be very uncomfortable, because the cap keeps getting bigger, because the rally keeps getting longer. And here we are in the mode where we are simply just retracing a quarter of the rally that we had previously, and it's uncomfortable not because of how far we pulled back on a percentage basis, but how far we pulled back on an absolute basis, which is a function of how big the rally was that preceded it. Let's pull up this chart now and take a look at what happened here today. Remember, yesterday we kind of had a not so risk-off day, where your kind of riskier assets didn't do so bad. We'll take a look at today. Look at what rallied up today. What finished the day higher among these areas was emerging markets, crude oil, and agricultural commodities were up here as well. That's a pretty decent day, not your typical risk-off asset classes. Not surprising, U.S. stocks were down here with developed markets, and you see crude oil actually started the day pretty bearish before rallying by the end. And of course, the dollar was up, but you notice that at the bottom here you have yesterday we had like dividend stocks and value stocks. Today, real estate continuing its weakness. There's your developed markets and the S&P. There's your dividend stocks again, all underperforming the ACWI. And then up here, your typical safe haven asset classes like bonds and the dollar, and gold to a much lower extent, is mixed with crude oil and emerging markets. So not your typical mixture of safe havens that you flock to when you're worried about market on the precipice of a free fall. Let's take a look at that 10-year note. Now remember, the 10-year note has the yield curve continues to invert. You've heard a lot of chatter, and let's pull up the daily chart. And it's not, remember this is using the Fred database here. Here I need to go to a daily chart. So keep in mind that for some of these values we're looking at 523, and then you can see these two here are updated as of 528. So we're still coming through the holiday weekend on the Fred database, and even the 3-month, which is what's inverted below the 10-year. Well, as they see, the 10-year is the 10-year is the black line here. The 3-month is the red line. So the 10-year has come down below the 3-month, obviously, and it's down even more, down to 2.2 almost % today. The black line has gotten down there. So that's what I'll show you now. T and X. Oops, let's just go T and X right there. Again, look, continuing how, and I showed you before how bearish we were yesterday. Again, MACD is an absolute value, but when you use the PPO, which is a MACD on a relative basis, we're pretty deep on this, as far back below the 200-day moving average as we are right now. A lot of chatter about this inverted yield curve. Keep in mind that this inverted yield curve that we're in is, there's a tweet, and I actually quote tweeted it. So if you follow me on Twitter, you probably saw this morning, or you can go see on my profile. Here, let's go 15 years. The idea that the yield curve, the 10 years below the 3-month, by the lowest amount since 2007. Of course, that's supposed to scare you, because this is what happened in 2007, right? The market peaked in October after the first rate cut in September, and then the stock market started had a 2008 50% decline. So a lot of people are scared. But the reality is we are right now in the environment on the yield curve. The yield curve is hitting this level on the way down. In 2007, the yield curve was hitting this level on the way back up. So we actually hit this level on the yield curve in middle of 2006, when the 10-year, the last rate cut, pulled the 10-year up above, and then as it pulled the 3-month up above the 10-year, the last rate hike, excuse me, in the middle of 2006. So the 10-year started to drop below the 3-month because of the rate hikes that the Fed was doing. So this was the environment where the yield spread between the 10 and the 3-month was hitting the current levels. That's more than a year before the market peaked in October of 2007. Again, look at the stock market, and you see, zoom in here on the 2006 here. In fact, let's do this. Let's look at the zigzag chart, and then let's change the zigzag to 5% pullbacks. So we'll do 5% pullbacks here and hit OK, and then let's go back and get those 15 years. Alright, so if I zoom in and I come over to 2006, the middle of 2006, when again we were hitting, the yield spread was hitting these levels that we're currently at. We were in the midst of a pullback then too, 7% decline in the middle of 2006, the last time the Fed raised interest rates. Well, after that decline ended at a 7% decline, coming off of a 12% rally, we went up 19% over the course of however many months that was, with very, very small pullbacks. That's a pretty good rally after the yield curve inverted between the 10 and the 3 month to the same extent as it is doing right now. So this is not a, and again, you can see even after that 5% pullback in early 2007, we had another 13% rise before the market finally peaked. Well, no, and even after that 9% pullback, we had another 11%. Then we finally rallied here after, we peaked well after. I mean, look, you can kind of see here from, if I were to draw a line from the low all the way up to that high point, after the yield curve inverted around this time, at the same extent it is right now on the way down like it is right now, we rallied up another 28% over the course of 484 days. So, kind of get me, that's more than a year from June to October. So about a year and 3 months, 15 months, a 28% rally in the stock market. So, and then we had the 50% pullback, but of course, there was excesses in the mortgage markets that led to that. We don't see those same excesses, and maybe in the corporate bond market is about as excessive as we've seen, but not nearly to the extent as we saw in the mortgage market that weighed on the financial sector at that time. All right, so if we take a look at the sectors and how they're performing, you can kind of see this is over the past 5 trading sessions, so a week's worth of, well, with the holiday mixed in there. So actually we need to go another day to get the 5 sessions here with the holiday in there. There we go. So there's 5 sessions. You can see the market's obviously down over the last 5 days. These cyclical sectors, technology, discretionary, industrials down. Your interest rate sensitive areas that are holding up the best because of how far yields are falling is real estate and utilities. Now let's just zoom in here just the last 2 days. Remember, yesterday was not your typical risk off day from a sector rotation. Utilities and real estate were the worst performers, even with the drop in yields that we saw. Well, you can see in the last 2 days now, including today, the market's down 1.5% in the last 2 days. Real estate, staples, healthcare, utilities are all still your worst performers over the past 2 days. And you have materials, technology, communication services holding up better. So again, little grain of salt in terms of this pullback. We're not really seeing a big drop here in cyclical areas that would suggest people are fleeing and heading towards the safe havens. In fact, people are kind of fleeing the strong gains that we've had recently in the safe havens and getting back into cyclical names as the market's trying to form this low point around this area. All right, one of those stocks that's in that consumer staples area that has been doing very, very well, even with the weakness that we've had in the markets here. See, it only reflected itself in light pink shading on this chart. It has been Procter Gamble. It's continued to move higher. Obviously, the short-term sentiment is a lot more bearish than we've been this whole rally, suggesting that we might get more of a pullback here. At least relative underperformance after relative strength in this stock and in this sector for so long. Obviously the red line, we're not dark pink shading yet, but the intermediate line is lower and closer to 50 this whole time that we've been in, with that near-term line suggesting we're going to get there. We already have the red line, obviously on the 3 green arrow chart. You can see we got 3 red arrows now with the red line on the moving average. If you take a look at those lines and see what they look like here, you can see how long those lines have been converging. Here, there we go. How long those lines have been converging. So, we had that really big push. We've been, excuse me. How about we do the right stock here? There we go. So we had the big push higher. You can see how we've been converging. Well, now the MACD is dropping below 0. Stochastic's moving for the first time during this rally, and the MACD stochastics dropping below 50. You can see both the 8 and the 17 close to dropping below the 70 as well. If you take a look at the Bollinger Bands, you can see during this MACD decline, we've also had relative weakness in the bandwidth. Now we're pushing into the lower half and pushing the lower band down into areas where there's not as much support until we get down to this 99.25 level. You can see the DMI indicator again has been so bullish during this rally. The orange line finally getting above 26. which is not the first time that that's happened, but is the first time it's happened with the blue line getting below 20. The bearish pattern developing there. And then finally, take a look at the long-term chart for Procter Gamble, and you can see how bullish we've been. And now again, when you get into such a gap, I don't think we'll fall all the way down to 96 anytime soon. But when we are in a big gap like this and you get below the 50, you can trade your way towards the 200-day moving average and fill in that gap. So we'll see. It didn't do that here at the end of last year during that big decline in 2018 and rally. We'll see if it ends up doing it this time at a much higher momentum level. Remember, on a PPO basis, which is apples to apples, right? Measures the MACD on an absolute basis here between the 10 and 40. It puts the gap between the 10 and 40 moving average in relation to the value of the 40-day. So you can try to put all of this in context. And again, you can see just how bullish we are. It is more bullish than we were at these levels, where we really peaked and filled in that gap pretty quickly. Again, I'm not expecting Procter & Gamble. I'm not buying a put here. I'm Procter & Gamble expecting us to get to 96 in a week. But you can see the potential for weakness, especially with the long upper shadow a couple of weeks ago, and now closing below, so far this week at least, the low point of that high week. So again, that pulls us up to our trade where we can say, okay, well, let's look at a bearish. Again, we don't want to buy a put because it's a strong bullish long-term trend, and the markets, I think, is in the midst of forming a low point. We're just expecting some relative weakness in this particular area that's been so strong during the market declines. So you can say, okay, well, if I sell the 106, 35 delta, and buy the 108, 47-cent credit gives me a 30% return on risk. I'm getting more than that here. Decent probabilities of that, and you can see where that blue line is the break even for the vertical spread. Remember, I'd be willing to give up a $53 loss on this because that's what we're trying to make on a maximum basis. So essentially, we'd have to offset and then some yesterday's big decline, pullback, and get back through this now volume resistance area and back into this area. And then in that case, we take a $53 loss and call it good. If we continue to push down, we might be able to get to that halfway mark pretty quickly here, and then call that good and move on to another trade and try to get the other half, right? See how long it would take us to get the other half. We might be able to get that other half on another trade quicker if we can get to the first half pretty quickly on this short call vertical spread. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping up there to go to our Market Outlook forums. Remember, you have to subscribe to our site to participate there. But open up any new threads there with questions or comments you have about anything we discussed in the video today or anything we didn't discuss that relates to this discussion. Open up any new threads. Reply to other people's threads. Let's keep the conversation going through tomorrow into the next video. So again, thank you very much for watching. Remember to subscribe to our YouTube channel, click that thumbs up icon, and comment on our videos. For more content, follow us on Twitter, and then join our community at marketscholars.com, as well as the Market Outlook community we created on Facebook. Have a great rest of your evening, everybody. We'll see you all tomorrow night.